Welcome to Market Peeker. The Relative Strength Index, or RSI, is one of the most popular indicators for spotting overbought and oversold conditions. Today, we'll show you how to use it effectively in your trading strategy. What is RSI? The RSI measures the speed and magnitude of price changes, displayed as a line between 0 and 100. It's designed to help you identify when an asset might be overbought, too expensive, or oversold, too cheap. How does it work? Overbought levels. If the RSI is above 70, the asset might be overbought and due for a pullback. Oversold levels. If the RSI is below 30, the asset might be oversold and ready for a bounce. Midline. A move above 50 often signals bullish momentum, while a drop below 50 suggests bearish momentum. How to use RSI in your trading? Reversals. Look for overbought or oversold conditions to anticipate trend reversals. For example, if RSI dips below 30 and starts rising, it might signal a buying opportunity. Divergences. If the RSI moves in the opposite direction of the price, for example, price rises but RSI falls, it could indicate a potential reversal. Trend confirmation. Use RSI alongside other tools like trend lines or moving averages for better accuracy. Pro tip: avoid relying on RSI alone. Combine it with other indicators or price action analysis to confirm your trades.